I want to bring in John Ryding. He is formerly worked at the New York Fed. He's now a chief economist and co-founder of RDQ Economics. And John, you and I have talked quite a bit about the Fed, and I know that you've often said that they're not preemptive enough on inflation. Did you hear anything more today that makes you feel better?
No, I mean, I think I feel it was pretty clear we're not getting QE3, so we're in a hole. Okay. We're not going to dig deeper, and that's a good thing. But I don't think that was a great surprise. The first thing I heard him say the most, and said it 4 or 5 times, was we have to wait for more information, particularly about the economy. I think the Fed were a little surprised about the softness of GDP, but I think that was a misleading indicator of the first quarter. And he did talk about the jobs numbers, and the jobs numbers have been much better than the growth, but it puts the Fed in a reactive mode. We're not going to make any step to start withdrawing accommodation until we've seen economic growth more clearly pick up. And so that puts the Fed on a period of hold in an extremely easy policy. And I mean, he correctly said, we're 2.5 years into zero rates now at this point. So a period of hold is going to get us to 3 years or so into zero rates and a massive balance sheet.
So you're saying, what more do you need, is what you're saying?
I'm saying that they're not going to take risks by preemptively addressing potential inflation concerns before seeing that the economy is on a sounder footing, and that puts the Fed in the backseat when it comes to making these policy adjustments. I think they're waiting too long.
But John, isn't there some validity to that? Because, as we've seen, data has changed from month to month. The markets have changed so quickly from month to month, quarter to quarter. Isn't there some validity to that, though?
Well, the problem is that monetary policy works with a lag. And so if we do have, we know we have an inflation problem, right? We know that the CPI is 3.2% year over year. It's the highest we've seen in almost 3 years. And the Fed's saying, on the one hand, when it comes to inflation, well, we see the inflation's here, but we think it's going to be temporary. His word's going to ratchet back. And so we're okay with inflation here. Now, the economy, on GDP terms, was softer, and so they want to wait to see that the economy is firmer, which to me says it's an economy first, inflation second approach to handling the dual mandates, which, of course, it's logically impossible for the Fed to...
Which you think is wrong?
Well, the Fed legally has to deal with the dual mandates, right? But they're clearly emphasizing the economy and employment over inflation and taking risks on the inflation front. The problem is, if they are wrong in that judgment, inflation gets out of hand, then it may well be costly to reverse. And, he talked a lot about the TIPS inflation expectations, but that number's been around 2.5%. He talked about the 5-year inflation expectation.
Actually, hang on there, Don, because that's exactly what I want to play for you, is what he said about TIPS. So let's roll that.
Some of the inflation numbers have been higher, and it does concern me. I do think expected inflation has drifted back down on the TIPS market in the last couple of weeks here. 5-year TIPS inflation is right around 2%. I mean, it doesn't get any better than that from the Fed's point of view. So I do think it's reasonable to think that some of our headline numbers will ratchet back here going forward.
Which is exactly what you were talking about.
Right. But not said is that the next 5 years, the inflation expectations are much closer to 3%. They were above 3% a couple of weeks ago, have come down a little bit. But, nevertheless, I think there's an element of when people see there's a problem on inflation, then we'll react to it. But we're at such a period of extreme accommodation. Let's think about the exit strategy he talked about. Okay, balance sheet first, in his opinion. But what's the balance sheet first? It's allowing the reinvestment of mortgage securities to start running off. Well, that's $15 to $20 billion a month. That's a very, very small exit when you've just gone out and bought $600 billion of treasuries on top of QE1, which bought all the mortgage-backed securities, government debt, and even more treasuries. So there's a very passive exit strategy. Changing the language would be another part of that before they start addressing rates. So the question is, if the Fed really wanted to get back to neutral, and they started in the several meetings that extended period represents, how many years would it take for the Fed to get back to neutral? It's going to take quite a long time.
I was going to say, how many years will it take then? Because it sounds as if even if they start, I mean, they are obviously going to start pulling back, it will take a very long time to, they'll be accommodative for a while.
For a very, very long time. I mean, QE2 finishes the end of June. Then we go into that holding pattern, looking for more information. Then maybe the first soft move could come towards the end of the year on changing the language. Back in 2004, they changed the considerable period language, which was extended period 2004 style, to saying they could afford to be patient in withdrawing accommodation, and then patient move to being measured in withdrawing accommodation, and then the rate hike started at a quarter-point meeting. Well, this time it's got to be balance sheet first before we even get to the rate hikes, and with such a large balance sheet, even making serious steps into beginning to tighten policy probably don't come until well into next year, and that's beginning, not ending accommodation.
John, I mean, Bullard, doesn't have a vote anymore. I think he's going to have a vote again in 2013. So do you feel, though, that the others that are going to come on board to the FOMC are going to put more pressure on Bernanke on inflation?
Well, I was at a lunch last week where Minneapolis Fed President Lakota spoke. And, he is also very clear that some move before the end of this year is indeed possible. I don't think we're going to get that. But he's a rates first guy rather than a balance sheet first guy. So there are even differences within the Fed presidents. But it seems to be that in your graphic where you had President Dudley and Governors Yellen and Chairman Bernanke, that is the group thing that is running policy. And these other presidents are making noises and soft defense. Jens Bullard said going into the last FOMC meeting, he's going to try and persuade the committee to leave the last $100 billion on the table for QE2, but he didn't think he was going to be successful. Clearly, he wasn't successful. But none of these presidents are dissenting. The dissenter, Tom Honig, was last year. We've got to see one or two of those presidents step up with a dissent.
John, thank you. Always great to have you on the program. John Ryding of RDQ.